Hello everyone, welcome to the 96th episode of me learning how to trade in Forex. So in the last video we went through how bonds yields affect currency movements. A bond is an I own you issued by an entity when it needs to borrow money. So when you own, for example, when you own a government bond, in effect the government has borrowed money from you. Bond yields refers to the rate of return or interest paid to the bondholder, while the bond price is the amount of money the bondholder pays for the bond. And bond price and bond yields are inversely related. There's a chart to help you, I guess, memorize what it looks like. There's another photo there. Bond yields serve as an excellent indicator of the strength of a nation's stock market, which increases demand for the nation's currency. Government bond yields act as an indicator of the overall direction of the country's interest rates and expectations. A rising yield is dollar bullish, a falling yield is dollar bearish. Yep. And now we're on to how bond spreads between two countries affect their exchange rate. So, how bond spreads between two countries affect their exchange rate. Oops, wrong date. So, the bond spread represents the difference between two countries' bond yields. Bond spread represents the difference between two countries' bond yields. These differences give rise to carry trade, which we discussed in the previous lesson. These differences give rise to carry trade. Spread some bonds all over me. Okay. By monitoring bond spreads and expectations for interest rate changes, you will have an idea of where currency pairs are headed. Here's what we mean. Why is it like that? Monitoring bond spreads and expectations for interest rates can give an idea where currency pairs are headed. Here's what we mean. Bond spread versus AUD USD. Bond spread AUD/USD. As the bond spread between the two economies widens, the currency of the country with the higher bond yield appreciates against the other currency of the country with the lower bond yield. Widens. AUD USD. As the bond spread between two economies widen, the currency of the country with the higher bond yield appreciates against the other currency of the country with the lower bond yield. As the bond spread between two economies widen, the currency of the country with the higher bond yield appreciates against the other currency of the country with the lower bond yield. You can observe this phenomenon by looking at the graph of AUD USD price action and the bond spread between Australia and the US 10-year government bonds from January 2000 to January 2012. Notice that when the bond spreads rose from 0.5% to 1% from 2002 to 2004, so 2002 to 2004 was it the bond spread, which is the blue line, to 1%, AUD USD rose almost 50%. So from here to here, rising from 0.5, so around here, to 0.7, around here. The same happened in 2007 when the bond differential rose from 1 to 2.5%. AUD USD rose from 7 to just above 0.7 to just above 0.9. That's 2,000 pips. So as the bond spread between the two economies widens, so increases, the currency of the country with the higher bond yield appreciates against the other country with the lower bond yield. So if it takes, what is this, AUD USD, isn't it? So it's taking, so you're buying Australian dollars with US dollars. So if the price is going up, that means you would need more USD to buy 1 AUD, which means AUD is appreciating or strengthening against the USD. So AUD is the one with the higher bond yields, whereas USD is the one with the lower bond yield. Is that right? Yeah, it should be. The same happened in 2007. Yep, that's 2,000 pips. Yep. Once the recession of 2008 came along, with all the major central banks started to cut the interest rates, AUD USD plunged from 0.9 handle back to 0.7. So from here to here. So what happens here? One factor that is probably in play here is that traders are taking advantage of carry trades. When bond spreads were increasing between the Aussie bonds and the US Treasuries, traders loaded up their long AUD USD positions. Why? To take advantage of the carry trade. However, once the Reserve Bank of Australia started cutting rates and bond spreads began to tighten, traders react by unwinding their long AUD USD positions as they were no longer as profitable. When bond spreads were increasing between the AUD, traders load up their long AUD USD positions. So as bond spreads were increasing between the Aussie bonds and US Treasuries, that means the currency of the country with the higher bond, which is the Aussie dollars, so Aussie dollars is strengthening against USD, so you need more USD to buy the same Aussie dollar, or one Aussie dollar, so it's increasing, the currency pairs increasing. Traders loaded up on their long AUD USD positions they were buying, so hoping for the price to rise. Here's one more example. So this is the GBP/USD versus UK-US 10-year bond spread. So buying GBP using USD. As the bond spread between the UK bond and US bond decreased, so that's the red line. So as this decreased, the GBP/USD weakened as well. So as a bond spread between two, so this isn't widens, this is decreasing. The currency of the high bond appreciates against the currency of the lower bond. So if the bond spread is decreasing, then traders were basically selling their long GBP USD positions because it's just not as profitable as it was before when it was a carry trade. Yeah, I hope that makes sense. Okay. So, how fixed income securities affect currency movements? How fixed income securities affect currency movements? A quick recap. So far, we've discussed how differences in rates of return can serve as an indicator of currency price movement. As the bond spread or interest rate differential between the two economies increases, the currency of the higher bond yield or interest rate generally appreciates against the other. Fixed income securities, including bonds, are investments that offer a fixed payment at regular time intervals. Fixed income securities, including bonds, are investments which offer a fixed payment at regular time intervals. Economies that offer higher returns on their fixed income securities should attract more investments. That offer higher returns on the fixed income securities should attract more investments because it's higher return. This would then make their local currency more attractive than those of other economies offering lower returns in their fixed income markets. So making their currency more attractive than the other economies offering lower returns on their fixed income securities and their fixed income markets. For instance, let's consider gifts or gilts and Eurobors. We're talking about UK bonds and European securities here. If Eurobors are offering a lower rate of return compared to gilts, investors would be discouraged from putting their money in the Eurozone's fixed income market and would rather place their money in the higher yielding asset. True? Because of that, the euro could weaken against other currencies, particularly the GBP. This phenomenon applies to virtually any fixed income market and for any currency. You can compare the yields on the fixed income currencies of Brazil to the fixed income market of Russia and use differentials to predict the behavior of the real and the ruble. Or you can look at the fixed income yields of Irish securities in comparison to those in Korea. Well, you get the picture. If you want to try your hands at these correlations, data on the government and corporate bonds can be found on these two websites, Bloomberg and Trading Economics. Government and corporate bonds. You can also check out the government website of a particular country to find out the current bond yields. Those are usually pretty accurate. They are the government. In fact, most countries offer bonds, but you might just want to stick to those whose currencies are part of the majors. Here are some of the popular bonds from around the globe and their cool nicknames. Right, okay, so, e.g. UK bonds versus Euro securities. If Euro securities are offering a lower rate of return compared to UK bonds, investors would be discouraged from putting their money in the Eurozone's fixed income market and would rather place their money in higher yielding assets. Therefore, EUR could weaken against other currencies because there is less demand for the euro. So there's less demand for it, then the price is gonna drop. So it's gonna weaken, the currency is gonna weaken. Particularly the GBP. This phenomenon applies to virtually any other fixed income market for any currency. You can compare the yields on fixed income securities of Brazil to the fixed income market of Russia and use differentials to predict behavior of the real and the ruble. Data on government and corporate bonds can be found on Bloomberg and Trading Economics. You can also check out the government website for a particular country. Also the government website of a country also shows the government website of a country. So the government website of a country shows the current bond rates, bond yields. Those are usually pretty accurate. They are the government. In fact, most countries offer bonds, but you might want to stick to those whose currencies are part of the majors. If buying bonds, stick to those whose currencies are parts of the majors. Here are some of the popular bonds from around the globe and their cool nicknames. United States, US Treasury bonds, Yankee bonds. United Kingdom, Gilts, Bulldog bonds. Japan, Japanese bonds, Samurai bonds. Eurozone bonds, Eurobors. Germany, bonds. Switzerland, Swiss bonds. Canada, Canadian bonds. Australia, Australian bonds. Kangaroo bonds, Matilda bonds. New Zealand, New Zealand bonds. Kiwi bonds. Spain, Matador bonds. Some countries also offer bonds with varying terms to maturity, so just make sure you're comparing bonds with the same term to maturity, such as 5-year gilts to 5-year Eurobors. Otherwise, your analysis would be off. Ensure comparison between between bonds from different country has the same terms to maturity, i.e. comparing 5-year UK bonds for 5-year Euro securities. Okay. And we will want that, would we? Yep. So, Forex and global equity markets. And global Did you know that equity markets can also be used to help gauge currency movements? Can be used to gauge currency movements. In a way, you can use the equity indices as some kind of a Forex crystal ball. Based on what you see on the television and what you hear on the radio and what you read in the newspaper, it seems that the stock equity market is the most closely covered financial market. We're in a recession, it may be a smart time to buy. Buy? Are you leaving? Did she just get fired? Layoffs, this is so depressing. Depression, we're in a depression. Sell, sell, sell. One thing to remember is that in order to purchase stocks from a particular country, you must have the local currency. To invest in stocks in Japan, a European investor would first exchange his euros into Japanese yen. So, to purchase stocks from a particular country, you must first have the local currency. This increased demand for JPY causes the value of JPY to appreciate. On the other hand, selling euros increases its supply, which drives the euro's value lower. So to buy stocks in Japan from Europe, the European investor must sell their euros to buy yen. So this increased demand for JPY causes the value of JPY to rise. Selling euros increases its supply, which lowers the value of the euro. When the outlook for a certain stock market is looking good, international money flows in. On the other hand, when the stock market is struggling, international investors take their money out and look for a better place to place their funds. Even though you may not trade stocks, as a forex trader, you should still pay attention to the stock market in major countries. Pay attention to the stock market in major countries. If the stock market in one country starts performing better than the stock market in the other country, you should be aware that money will probably be moving from the country of the weaker stock market to the country of the stronger stock market. If the stock market in one country starts performing better than the stock market in another country, be aware that money will probably be moving from the country with the weaker stock market to the country with the stronger stock market. This could lead to a rise in the value of the currency for the country with the stronger stock market, while the value of the currency would depreciate for the country with the weaker stock market. So, leading to a rise in value of the currency with for the country with a stronger stock market, whilst the value of the currency would fall for the country with the weaker stock market. Here's a general idea. Strong stock market equals strong currency, weak stock market equals weak currency. Market, strong currency, weak stock market equals weak currency. If you bought the currency from the country with the stronger stock market and sold the currency from the country with the weaker stock market, you can potentially make some nice dough. If you bought the currency from the strong country with the stronger stock market, so the strong currency, and sold the currency, so selling the weak currency to buy the strong currency basically, you can potentially make some nice dough. So sell the currency with the weak stock market to buy the currency from the strong stock market to make cash. Not too familiar with the major global equity indices? Here is your lucky day. Here they are. Equity index, Dow. The Dow Jones Industrial Average, or Dow for short, is considered to be one of the premier stock indexes in the US. It measures how well the top 30 publicly owned companies are trading. Despite the name, barely any of the companies have anything to do with the industrial production and are instead representative of some of the biggest companies in America. It is closely watched by investors around the world and is highly indicative of market sentiment, thus making it sensitive to both local and foreign economic and political events. The companies that are part of the Dow are so large that you probably deal with at least one of them every day. Imagine life for Apple, McDonald's, Disney or Nike. Yes, these companies are all listed in a Dow. S&P 500. The Standard & Poor 500, more commonly known as the S&P 500, is a weighted index of the stock prices of the 500 largest American companies. It is considered a bellwether for the American economy and is used to predict its direction. After the Dow Jones Industrial Average, it is the most traded index in the US. Some mutual funds, exchange-traded funds, and other funds such as the pension funds are designed to track the performance of the S&P 500 index. Hundreds of billions of US dollars have been invested in this fashion. NASDAQ. NASDAQ stands for the National Association of Securities Dealers Automated Quotations. It refers to the largest electronic screen-based equity services securities trading market in the US, comprising approximately 3,700 companies and corporations. It also boasts of having the largest trading volume on the world's stock markets. Nikkei. The Nikkei, similar to the Dow Jones Industrial Average, is the most widely quoted average of the Japanese stock market. It is a price-weighted average of the top 225 companies and is supposed to be reflective of the overall market. The Nikkei includes companies like Toyota, Japan Airlines and Fujifilm. DAX. The DAX is short for the Deutsche Aktien Index. You're probably better off remembering just DAX. It is the stock market index in Germany that consists of the top 40 blue chip companies that are traded on the Frankfurt Stock Exchange. With Germany being the largest economy in the Eurozone, the DAX is normally the most closely watched index within the whole Eurozone. Some companies that are part of the DAX are Adidas, BMW and Deutsche Bank. DJ Euro Stoxx 50. The Dow Jones Euro Stoxx 50 index is the Eurozone's leading blue chip index. It comprises over 50 top sector stocks from 12 Eurozone countries. It was created by Stocks Ltd, which is a joint venture of Deutsche Börse AG, Dow Jones and Company and SIX Swiss Exchange. FTSE. The FTSE, pronounced FTSE, or the FTSE index tracks the performance of the most highly capitalized UK companies listed on the London Stock Exchange. There are several versions of this index, such as the FTSE 100 or FTSE 250, depending on the number of companies included in the index. Hang Seng. The Hang Seng Index is a stock market index in Hong Kong. By recording and monitoring daily price changes of the stocks included in an index, it tracks the overall performance of the Hong Kong stock market. This index is currently compiled by the HSI Services Limited, which is a subsidiary of Hang Seng Bank. Okay. So, major global equity indices. Dow, S&P 500, Nasdaq, Nikkei, DAX, DJ Euro Stoxx 50, FTSE, Hang Seng. I could probably make some I should probably make some like facts page for each of these equity indices to get to know more about them. So do more reading on each of these equity indices in the future. Note to self. So oh my god, that spelling. The relationship between stocks and Forex. One issue with using global equity markets to make Forex trading decisions is figuring out which leads which. It's like answering the age-old question, which came first, the chicken or the egg? Or who's yo daddy? As are the equity markets calling the shots, or is the Forex market that wears the pants in the relationship? The basic theory is that when a domestic equity market rises, confidence in a specific country grows as well, leading to an inflow of funds from foreign investors. So, basic theory is that when a domestic equity market rises, confidence in that specific country grows as well. So leading to an inflow of funds from foreign investors. This tends to create a demand for the domestic currency, causing it to rally against other foreign currencies. Therefore causing a demand for the domestic currency, causing it to rally against other foreign currencies. On the flip side, when the domestic equity market performs terribly, confidence falters, causing investors to convert their invested funds back into their own local currencies. Sounds great in theory, but in reality it's complicated. For example, the historical relationship between the US dollar and the S&P 500 hasn't been consistent. As shown below, over the last 20 years they have moved together, moved in opposite directions, and have been unrelated. From 1995 to 2000, equities and USD rose together. The relationship broke when the tech bubble burst, so now they're moving in the opposite directions. And from 2003 to 2008, equities and USD went in opposite directions. So as one went up, this one goes down. Oh no, they're still moving together, these. So this one goes up, this one goes down. Over the last 5 years, equities rallied while the USD was unchanged. So equities went up, the USD was just hanging about. But that doesn't mean that the relationship is useless. You just have to know when the correlation is working, whether negative or positive, and when it's not. However, this isn't always the case. So, although relationships between the stock and Forex market can sometimes be inconsistent. You just need to know when the correlation is working, whether negative or positive, and when it's not. Here's an example of where US and Japan stocks move in opposite directions of their currencies. Any upbeat economic figures in the US and Japan more often than not weigh down on their respective currencies, the dollar and yen. Any upbeat economic figures in the US and Japan more often than not weigh down their own respective currencies. First, let's take a look at the correlation between the Dow Jones Industrial Average and the Nikkei to see how the stock market all over the globe perform relative to each other. So Dow Jones versus Nikkei. Notice how they move in tandem, so it's one goes down, the other goes down as well, one goes up, the other goes up, go down, go down, go up, go up. Since the turn of the century, the Dow Jones Industrial Average and Nikkei 225, the Japanese stock market index, has been moving together like lovers on Valentine's Day, falling and rising at the same time. Also notice that sometimes one index leads rallying or dropping first before being followed by the other index. It doesn't happen every single time, but you could say that stock markets of the world generally move in the same direction. Right. Whoa, not left. How the stock market affects the Forex market. Let's see how the Forex market can affect the stock market, specifically stock indexes. When people talk about the stock market, you generally hear them using a stock market index in reference to the market's performance. A stock market index is simply a curated basket of certain stocks. Index is a curated basket of certain stocks. This list of stocks is a way to get a broad measure of what's happening in the stock market. So stocks is a way to get a broad measure of what's happening in the stock market. In this lesson, we'll discuss how currencies can have an effect on two specific stock indexes. The Nikkei 225, more commonly called the Nikkei index, or the Nikkei stock average, is a Japan stock market index that measures the stock performance of Japan's largest 225 companies, largest 225 companies listed on Tokyo Stock Exchange. The Dow Jones Industrial Average, Dow Jones, or simply the Dow, is a US stock market index that measures the stock performance of 30 large American companies listed on New York Stock Exchange and the Nasdaq. Nikkei and USD JPY, so selling the JPY to buy USD. Before the global economic recession that happened in 2007, when most economies suffered consecutive quarters of negative GDP growth, the Nikkei and the USD JPY were inversely correlated. Investors believed that the performance of the Japanese stock market reflected the status of the country, so a rally in the Nikkei led to a strengthening of the yen. The opposite also held true. Whenever Nikkei would drop, USD JPY would rise as well. So you need to use more JPYs to buy one USD, which means JPY is weakening against USDs. So lately the two have been positively correlated, so basically doing the same. When the financial crisis hit, however, the relationships went crazy like Lindsay Lohan. The Nikkei and the USD, which used to move opposite, now move in the same direction. So this is the opposite, so one goes down, one goes up, and now they move in the same direction. Amazing, isn't it? Who would have thought that stocks would have something to do with this foreign exchange markets? Correlation between USD JPY and Dow. So the same USD JPY. Let's take a look at the correlation between the USD JPY and the Dow. Generally, the strength or weakness of the dollar impacts the US stock market, particularly stocks of large multinational corporations. So strength or weakness of the dollar impacts the US stock market. For large US multinationals that sell goods and services overseas, a rising US dollar can put a crimp into their profits. If the dollar is strong, it makes a difference for those companies, as it makes it difficult for them to increase prices or even maintain sales at current levels. For large US multinational that sell goods over the seas, a rising dollar can decrease their profits. If the dollar is strong, it makes it difficult for those companies to increase prices or even maintain sales at current levels. That said, you might assume that the USD JPY and the Dow would be highly correlated. However, look at the chart below will tell you that this isn't quite the case. Where correlation is positive, it isn't as strong. Take a look at the Dow, the blue line. It peaks at 14,000 late in 2007, so around the blue line, around here, before dropping like a hot potato in 2008. Boom. At the same time, USD/JPY, the orange line, also fell, but not as sharply as the dough. This serves as a reminder that we should always take into account fundamentals, technicals, and market sentiment, so always read up. Don't forget correlations, don't take correlations for granted because they aren't always a surefire thing. Don't take correlations for granted, as it's not always true. Okay. I'm going to leave this episode here. In the next video, we're going to carry on with using equities to trade Forex, with how to use Euro/JPY as a leading indicator for stocks. So thank you all for watching this episode, and I will see you guys in the next one. Bye!